Hello, in this video we'll be going through long-term notes that are issued for cash or assets. What is a long-term note? Long-term note is when a company borrows money from a bank and signs a promissory note, and then that note is reported as a liability on the company's balance sheet. So two sides to every long-term note. You have the borrower is the one who borrows the note and they record a notes payable in the liability section. And then the lender records a notes receivable in their balance sheet in the asset section. We're going to go through some examples. The first one is the simplest, and it's when a note is issued for cash. On January 1, 2027, Skill Graphics Inc., a product labeling and graphics firm, borrowed $700,000 cash from First Bancorp and issued a 3-year $700,000 promissory note. Interest of $42,000 was payable semi-annually on June 30th and December 31st. So how do we record that when it's first issued? Skill Graphics, who's the borrower, received cash, so they're going to debit cash $700,000, and they record the liability and notes payable on their balance sheet for $700,000. First Bancorp, the lender, now has a receivable on a notes receivable for the face amount on their balance sheet, and they credit cash because now they lent out that cash. Let's see what the entries are for each. There's going to be 6 interest payments made because it's a 3-year note and interest payments are made semi-annually. The borrower has to pay the interest. So they're going to debit interest expense every 6 months for $42,000 and credit cash for $42,000. And that interest payment is going to be the stated rate times the face amount. And we're not told in this, but the stated rate is 6% because it's 12% divided by half. And First Bancorp, the bank itself will debit cash because they received the $42,000. And that $42,000 is considered to be interest revenue, so they're going to credit interest revenue. When Skill Graphics pays off that note, they're going to debit that note payable for $700,000, and they will credit the cash for the face amount, the $700,000. And then the lender, Bancorp, will receive the cash, so they're going to debit $700,000, and they're going to credit the notes receivable off of their books. So that's a pretty straightforward, simple note payable for cash. Now, what happens when we have a situation where a note is not exchanged for cash, but rather it's exchanged for an asset that's not cash or services? Okay, let's look at this. And we have what's called imputed interest rate is one scenario. First of all, no loan is going to be interest-free. No one's going to lend you money for free because then otherwise everyone would be doing it, borrowing that money for free. So when we have a note, right, for an asset, so I buy a machine for $1,000 and I give you a note instead of cash, we assume that $1,000 includes interest, right? It's some of it is for the machine and some of it is for interest, and we assume that the stated interest that's implied in that $1,000 is the fair interest unless that promissory note has no interest stated, so we don't know what it is, or if that stated interest is unreasonable, right? Because it's not really what is going on in the market. It's not similar to what's going on out in the open market of what you could get a loan for. Or if there's a large discrepancy between the face value of the note and the asset that is being purchased. So if I purchase a $1,000 asset from you, and then you and I have a note payable for $10,000, and what I received in exchange for that is a $1,000 asset, that's not reasonable, right? That means there's $9,000 of interest in here that I am paying you. That's not reasonable. If you have this during an exam, it will be apparent that this large discrepancy, what that is an unreasonable large discrepancy. So if A, B, or C are true above, then what do we need to do in order to determine what the interest rate is? Well, we can look at the fair value of the goods or services. So if I purchased an asset from you for $1,000, right? And we say, well, the note's going to be $11,000. We'll have notes payable for 11 and not 11, 1,100. Sorry, adding zeros here. So if my notes payable is $1,100 and the asset I get is $1,000, well, then you can imply that there's $100 of interest embedded in the note, and that's okay. And you can say you can back into the interest rate for that $100 is 10%. Or if no interest rate is stated, if A, B, or C up here, if one of these is true, then, and you don't have the fair value of the goods or services, you can say, well, what's the fair value of the note itself? And how do you determine the fair value of the note? That would be the amount that a market participant would pay for that note, which would be equal to the present value of the principal and plus the present value of the interest payments that are discounted at a realistic market rate. That should sound pretty familiar if you've watched other videos. When we watch other videos for bonds, and that's when, to determine the price of a bond, you have to take the present value of the principal plus the present value of the interest payments. It's the same concept for a note. So if you can determine the fair value of the note, right, which is what someone would be willing to pay for the note, then you can back into the interest that is embedded in that note. Now, if you don't have the fair value of the note and you don't have the fair value of the goods or services, then you have to what's called imputing. I'm going to hear the circle. You have to have an imputed rate. And the imputed rate is you have to determine a rate for that note that is similar to what you can get out elsewhere. So it's a rate that's prevailing. It's a prevailing rate to similar instruments. So if you go out to the bank, and if I went out to the bank and I wanted to borrow $1,000, right, because my asset costs $1,000, what rate would the bank give me to borrow $1,000? That would be a similar instrument, prevailing rate, a similar instrument. So let's take an example, right, when we have a note exchange for asset or services where we have to impute the interest rate, okay? On December 31, 2029, ABC Corp issued a 3-year, 90,000 2% promissory note to XYZ Inc. for a machine provided during 2029. ABC Corp cannot readily determine the fair value of the machine, nor is the note readily marketable. So ABC Corp issued a $90,000 2% note to XYZ for a machine. Now, if ABC Corp were to go borrow money from the bank to pay for the machine, they would be charged an 8% interest rate. So what do? Do we record this note using the 2% rate, or do we record the note at the 8% rate? Well, we have to go through the steps. First, do we know the fair value of the goods or services? The problem tells us we do not know the fair value of the machine. Do we know the fair value of the note? Well, the problem tells us the note is not readily marketable. So we do not know what someone in the open market would pay for this note. So then what we have to do is we have to impute an interest rate that is prevailing rate to similar instruments. And we're told that if we were to go out and borrow this $90,000 from the bank, they would charge us an 8% interest rate. So when we value this note, right, we have to use an 8% interest rate. So this is just So we have this $90,000 note that we paid for the machine, and basically the machine embedded in this $90,000 is the actual cost in the machine plus the interest that we're paying on the note. So so we have the principal plus the interest equals the $90,000. That's what we're looking at. So how do we figure out what is the cost of this machine and what do we need to record as the issuer and as the borrower, the lender, I'm sorry. So what we're going to do is this is exactly the same steps as you would do to calculate a discount or a premium on a bond. If you don't know how to do that, please go to the video called Discounted Bonds. So first step is I'm going to have to find out the present value of the principal of the face amount, right, which is $90,000, using my N equals 3 because it's a 3-year note, and my interest that I'm going to use using my present value of $1 table. I should say present value of $1 for $90,000. I equals 8, because even though the problem says that the note is a 2% note, that is not a reasonable interest rate, and so we're going to use 8. So, well, it's not reasonable, but also we don't know the fair value of the machine, and the note is not readily, the value of the note is not readily available. So when I go into my present value of $1 table, I look $90,000 using N equals 3, the number of periods, and the interest equals 8. I get $71,400. Second step is present value of ordinary annuity for the interest payments, okay? So the interest payments that I'm going to pay is going to be the $90,000. Now, to calculate the interest payments, you do use the rate that is stated in the note. So that's 2%. So that's $1,800. And I'm going to use, again, the present value of ordinary annuity using N equals 3, I equals 8%. And that's $1,800 times 2.57710. And that equals $4,639. Okay, I'm going to add both those up to give me $76,039. I switched screens just so I have more room, and I rewrote what we just went through up here. But let's go through the journal entries that the issuer would record, ABC Corp, right? They now purchased this machine. So they're going to debit machine or machinery for the cost of the machine, which we've determined is $76,039. They're also going to credit a notes payable for the face amount of the note, which is $90,000. And the difference is going to be called discount on notes payable, which is $13,961. If you look at this journal entry and you go back into the video called Discounted Bonds, this is the exact same calculation when you issue a bond for a discounted price. And just like in the bond situation, when you have a discount on the notes payable, you're going to go and you're going to amortize this $13,961 as part of the interest expense. We're going to record an interest payment of this is every year of $1,800, and then we're going to record interest expense for a portion of amortizing this down to 0. That is using the effective interest method. You can go back to look at that video to see how that would be done, but it is the exact same calculation whether you have a discount on bonds payable or a discount on notes payable. Let's go look at the lender of this. This is XYZ Corp. They're going to debit a notes receivable for the full face amount of the note, which is $90,000. They're going to record sales or revenue sales for the cost of the machine, which is $76.39. And then their difference is going to be on their end, it's going to be called discount on notes receivable for $13,961. That's a credit. So $13,961. So we just went through what was called an imputed interest rate. There's also sometimes what's called an implicit rate of interest, and that is when the rate is not expressly stated in the agreement, but based on the information that's given, you can back into the rate that was computed. So here's an example of, it's the same set of facts, but just you're given different information. On December 31, 2029, ABC Corp issued a 3-year, $90,000 2% promissory note to XYZ for a machine provided during 2029. So far, this is the exact same information we've received as when we calculated the imputed interest rate. If ABC Corp were to go out and buy the machine for cash today, the cost of the machine would be $76,039. So in this, when you have an implicit interest rate, you already know what the cost of the asset that you're purchasing is, and you're given what the face value of the note with a stated interest rate. And so therefore, we know based on what we just did in the prior example, that the market rate using is 8%. If you were to take the $90,000 in present value, the principal and the interest payments, right, using an 8% rate, you would get the cost of the machine to be $76,039. So even though the market rate is not flat out stated, it is implicit in the interest rate, right? It's not stated in the agreement, but it's there. It is already using a specific market rate to determine what the cost of the machine is.